Hello, everyone. Thanks for coming out. Before we dive into our presentation, let's warm up with a little tax brain teaser. So after working hard for his adult life, Bill, who's 65, has finally retired. He's going to more concerts than ever before. He's got about $42,000 in taxable income, which includes $25,000 of Social Security benefits this year. So as you can see, Bill's $42,000 of taxable income puts him in the 22% tax bracket. Because it's more than 40,525 and less than 86,375. Towards the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much is he taxed on that extra $1,000 that he takes out from his IRA? The logical answer is that every dollar of IRA money that he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22% tax bracket, pretty straightforward, pretty simple. However, he owes $407 in taxes, which would equate to a 40.7 federal tax rate on that $1,000 that he pulled out. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. So it's definitely shocking, almost to the point where it can't possibly be true. Especially when you look at it, if the top tax rate on a single person is 37%, and that rate doesn't begin until they have more than $510,000 of taxable income. How can Bill pay a higher rate when he's got a lot less income than that? So yeah, it doesn't make any sense, but here's the thing. It doesn't have to. It's the tax code, and sometimes it doesn't. Later, I'll explain more about why Bill faces that tax bill. But for now, the important thing to realize is that when it comes to taxes, the obvious answer is not always the correct answer. So welcome to our presentation, How Tax Planning Changes Through four stages of retirement. My name is Mark Bautis. I'm the founder and owner of Bautis Financial. I want to thank you for coming out, learning more about taxes and retirement. And I want to assure you that one thing about this presentation, I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. So from time to time, I present workshops and classes on various financial education topics, such as Social Security, retirement planning, IRA planning, healthcare, cybersecurity, late stage college planning, amongst others. My goal is always to inform and educate, so that way you can understand some critical financial planning topics that sometimes it's hard to get information on. You can see replays of our past webinars on our website at bautisfinancial.com/learning center, as well as register for upcoming ones. We hold these webinars every 2 weeks. It's also a place where you can go to get all of the resources that we talk about in today's presentation. So I do this presentation on tax planning because I've seen many people make mistakes and pay more in taxes in retirement than is necessary. And when that happens, it makes my job as an advisor harder because people have less income in retirement and we have to find ways to make their portfolios last or so that they never run out of income. Taxes can seem complex, jargon-filled, even though the underlying concepts, they're fairly straightforward. So let me take a second, explain how this workshop will unfold. So the presentation is organized into 4 keys. Each key builds on the previous one to form a solution to some common problem that we'll look at. You may have questions as we go along. I have my colleague Kira on this webinar. She'll be monitoring the chat and the Q&A section. So if you have something you have a question on, please put it in there. I'll stop periodically during the presentation and we'll see if there are any questions. I'll be glad to talk to you about your specific situation. I want to mention that at the end of the presentation, I'll invite you to a taxes and retirement planning overview meeting. This is a complimentary one-on-one meeting that I offer so we can discuss in private any issues raised or concerns or questions by today's presentation. So I'll tell you a little bit more about that at the end. And then also, I just want to assure you this is not a sales presentation. You'll hear nothing remotely close to it. If you listen to any of my previous ones, you'll see that it will take the same approach as this one. It's purely educational. And then one other thing that I do have to mention is everyone's tax situation is different. You should always contact or consult a qualified professional tax advisor to discuss your specific situation, especially about some of these topics of IRAs, Roth IRAs, where there's different federal and state and potentially penalties that are associated with them. So our goal here is to help you understand the retirement distribution game, which is obviously spending assets in retirement. It's much different than the accumulation game, which is when you're in that phase where you're working and you're saving for retirement. Chances are you've been in that accumulation phase of your life for several decades. You're working hard, you're trying to save money, and hopefully your portfolio or your accounts or your assets have grown over that period of time. But now as you enter or prepare for retirement, you're in an entirely different phase. It's the distribution phase. And the distribution phase has new, strange rules that can catch you off guard. And along with those new rules, there are often changes in your own personal life that you're going through as well that can have a big impact on your taxes too. So like, for instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off. That means no more mortgage interest deduction. If you've already retired, you may no longer be receiving employer-paid health care. If you stop working, you also may not be contributing to a 401k or an IRA and getting that tax deduction for making the contribution, nor are you having your portfolio continuing to build up with new contributions to it. At some point, you're probably going to start taking Social Security. When you hit 72, you're going to start having required minimum distributions, and you can see the list goes on. And many of these aspects of retirement will impact your tax bill, which in ways that are really different than when you're working. So understanding some of these rules, how they are, how they can impact you, it's really crucial to do. So that brings us to this simple statement about the problem that we're here to discuss. And simply put, people often pay more taxes in retirement than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. So we're going to go back to in the accumulation phase, people build their assets in several different forms. Could be stocks, bonds, savings, bank accounts, real estate, pensions, 401ks, IRAs, and more. In the distribution phase, your regular wages stop coming in. So you have to take that money that you saved and use it to fund your retirement, to basically rebuild that paycheck, which can go on for decades. If you have good health, people oftentimes assume, all right, I'm retiring, I'm just going to need to be very conservative and just pull out my money. But we're seeing 30-year plus retirements nowadays. So it's challenging. You need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, the tax rate can vary drastically based on the decisions that you make, such as the timing, the order in which you use different sources of money to pay for your expenses. And throw that on top of that, it seems like the tax laws are changing every year or every couple of years. So on top of trying to figure out how to tap your retirement accounts, you're often dealing with changing tax laws, which means different tax costs for how you tap this money. So poor choices through whether it's misunderstandings, ignorance of the rules, they can result in paying more tax than necessary, which turns around and causes your savings or your assets to decrease faster than they probably should have. So because tax exposure will change throughout the 4 stages of retirement, what we're going to talk about is having a strategy that anticipates both traditional taxes, possible taxes, surcharges, penalties, and not just with your portfolios, but also related to things like Social Security, Medicare, and other income sources. So again, it means you need to be informed and have a proactive plan that addresses how you'll create income in retirement. So before we go on, I just wanted to go over what the 4 stages of retirement that we're going to discuss are. And these are rough ranges and descriptions. We know, obviously, for everyone, retirement is different. So it's just a framework for discussing the topic. So first, you have your pre-retirement. That's your, the final work and save years. For some people, it's those ages 50 to 60. Then next, you have the early years of retirement, which can be that 60 to 70 years. Oftentimes, it's called the go-go years. So people often, have grand plans for traveling, new hobbies, volunteering, working part-time, spending more time with family. Third, or next, you reach the middle years of retirement, which is 70 to 80, which are the go-slow years. And this can bring on more financial decisions, such as how to deal with your required minimum distributions, how to take distributions from your IRAs and other retirement accounts. And then finally, there's late retirement, the late years of retirement, where your health may not be as good, and you're thinking about your legacy and your estate, And these are often called the no-go years, which may start around 80. And again, you'll see there's a wide range of issues that you have to plan for in each of these stages or each of these phases. And it can be a lot harder than it seems because retirement is full of surprises. You think you might flip that switch and you kind of just figure out as you go along what you're going to do, what you're going to spend on. But even the best planning, it sometimes diverts from reality at some point. So, some of the things that, the gotchas or the landmines of retirement, you have inflation. People tend to plan their retirement expenses, but don't figure in the fact that prices rise over time and their expenses are going to rise over time. So if you think back 30 years ago to the cost of a gallon of milk or a gallon of gas, now think about what those cost now, and you can see how quickly prices rise. Sometimes, you see drastic rises over 30 years. Sometimes it's drastic rises over a short period of time. Also, there's longevity. Many people, because of improvements in our healthcare, many people are living a lot longer than they expect to. And when we do planning, we'll often put a projected age of how long the plan will last, and we're seeing people live well into the 90s and into hundreds. And you need to figure out how you're going to pay your expenses for those years as well. I think people also underestimate how much money they're going to need to maintain that pre-retirement standard of living. There's some rules of thumb where you say, okay, I'm going to need to use 70% of what I spend now because maybe some medical expenses will be higher, but I'm not commuting or I'm not doing this. But oftentimes I see in planning that people do underestimate what they spend, and no one wants their standard of living. I've never come across someone that says, well, I want to have a less standard of living in retirement than I do now. And then there's healthcare, which is the 10,000-pound gorilla. So it includes your out-of-pocket payments for services and drugs like Medicare, insurance costs, long-term care potentially. And then last but not least, there's market volatility. Everyone I talk to says, I don't want to have any market volatility. I don't want to deal with any ups and downs. But then you look at their portfolio and maybe they do need some growth to be able to, again, build that paycheck over time. So these are all things just examples of things that have to be planned for in retirement. So at this point, you're thinking, okay, so what's the first thing I need to understand about retirement and taxes? So first key number one is you have to know what your after-tax retirement savings picture looks like before you actually retire. So that's an important thing. With anything that I talk about in planning with anyone that I meet with, you always say that time is the biggest benefactor to really having a successful putting a successful financial plan together. And successful financial plan can mean a lot of things, but the earlier you start, the better you're off. Same holds true for retirement. So, because the other thing to think about, and I mentioned it on the slide before, is after-tax picture of it. Because a $500,000 401k or IRA balance isn't really $500,000. You have a partner in that IRA, and it's the government. The government has a claim on part of that money because taxes were deferred on it. You got a deduction for the contributions that you put into it. So they'll get their fair share when you're forced to start your required minimum distributions after you turn 72, or you're able to pull out money without paying a 10% penalty once you turn 59 and a half. So in some cases, it makes sense to take out money prior to 72, while in some cases it makes sense to defer and deduct it as long as possible. Obviously, the higher tax rate you're in retirement, the less your account actually is worth. So here's a quick example. So this chart shows you a cumulative after-tax amount that you could expect to receive from a $500,000 IRA, earning 6% per year at various tax rates. As you can see, the lower your tax rate, the more you keep. So simple in theory, but difficult in practice. And by the way, this presentation also applies to pre-retirees and retirees. So even if you've already started your retirement, and even if you are pulling money out of any of your retirement assets, the tax planning still holds true, and it's important throughout your retirement as well. So you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll still have a steady flow of benefits from Social Security to supplement my income. And then you'll have your Medicare, obviously, to pay your healthcare, to pay for your healthcare costs. But the one thing to understand when creating a retirement strategy is that Social Security and Medicare, they often have their own tax traps that you need to plan for as well. So we're going to talk about a couple of those. So remember the tax brain teaser that we started out with Bill. And we want to now talk about why he's going to pay such a high tax rate on that extra $1,000 that he took out of his IRA to go on a road trip to go see a concert. So remember, Bill has $38,000 of IRA income, which is part of his adjusted gross income of $56,525. The other part of it is that $25,000 of Social Security benefits. So it puts him squarely in the 22% tax bracket. He takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate, $407, on that $1,000. So let's talk a little bit about how that actually happens. And first thing is, remember, the only difference between our two scenarios here is that Bill has taken an extra $1,000 out from his IRA. So we're looking at the comparison between the two. And that's where you see in the after concert trip column, where he has $39,000 in IRA income versus the $38,000 that he had prior to the trip. So we see here that by adding the additional $1,000 of income, it increases AGI and his taxable income by $1,850. So that means that for every dollar of income he's actually received, he's being taxed on $1.85, which doesn't make sense. So depending upon how much other income you have, the amount of your Social Security benefits that are taxable vary. So for instance, if your other income is low enough, all of your Social Security benefits will be income tax free. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. I get a lot of questions where people say, does that mean I'm paying 85% tax on my Social Security benefits? No, it means that 85% of your benefits may be taxable at whatever your income tax rate is. So Bill finds himself in this situation. At his current income after the trip, where he took out that extra $1,000, for every dollar that he takes out of his IRA, not only does he add $1 of IRA money to his taxable income, but he also must add an additional 85 cents on his taxable Social Security benefits that he wasn't being taxed on previously. So if you add that up, it's $1.85 taxable at his 22% rate for every $1 of additional IRA income that he actually receives. So if you do the math on it, that's how we get to that 40.7 real tax rate on the additional $1,000 of income. And that's one of these so-called Social Security tax torpedoes. So it can impact single filers, it can impact married couples, even with fairly modest income during any stage of retirement. And again, it's one reason that planning for taxes in retirement, it's really important to do. Okay, so we're going to stop there. Kira, any questions for now?
There are no questions so far.
Okay, perfect. All right, so we're going to continue on, and let's look at another aspect of Social Security and taxation and how people approach retirement. So here we're going to look at during the go-go year stage, and some people retire altogether, but other people, and we're seeing this more common, enter in this sort of semi-retirement. Sometimes it's a continuation of a previous job, just with fewer hours. Others use semi-retirement to explore an interest in a new field, and still others use semi-retirement to pursue non-paid or rewarding volunteer work. So working in retirement can impact your planning and taxes in a couple different ways. Some good, some bad, and some that are just downright ugly. So let's take a look at how working during these years can be a good thing. Chances are you've researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit, it's calculated using your highest 35 years of inflation-adjusted earnings. And so what if you started working late in life? Or what if you left work to raise children at some point? You may not have 35 years of earnings history. Suppose you only have 28. Well, the remaining 7 years count as a big zero when they calculate your benefits. But there's good news. Earning at any age can help increase your Social Security benefit. And thanks to how Social Security calculates benefits, replacing several years of zeros with even modest earnings can positively impact your benefits. So let's take a look at how working can be somewhat bad if you're already collecting benefits and unaware of this Social Security earnings limit that applies prior to reaching your full retirement age. Here's how the rule works. If you start Social Security, be it your own retirement benefit or even spousal benefits, prior to the year you reach your full retirement age, for every $2 above a certain amount, that you earn, which in this case is $18,960 in 2021, Social Security will withhold $1 of benefits. And keep in mind, we're talking about earnings here, which is W-2 salary, self-employment income, not pensions, interest, dividends, or capital gains. They don't count and they won't reduce early Social Security benefits. So for instance, let's say you earn $20,960 in 2021, which is $2,000 over the limit. Therefore, under the dollar withheld for $2 of earnings rule, Social Security would withhold $1,000 of your 2021 benefits. But these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as though if you had applied at full retirement with respect to those withheld benefits. So it's a little bit confusing. Not all, I guess to summarize, not all is lost because you do make up for some of it when you do hit full retirement age. But also in the year you do reach full retirement age, there's a separate higher earnings limit that you're able to take. All right, so we talked about the good, we talked about the bad. Now let's talk about the ugly. And what this really pertains to is that there are other taxes you may face. So for instance, while you're working, you may be subject to 7.65% Social Security and Medicare taxes in addition to income tax. And if you're self-employed, that comes out to 15.3%, which covers the employer's contribution as well. So these taxes don't go away if you're working past your full retirement age, or even if you're collecting Social Security. And even worse is if you're in your go-go years, the earnings don't make it to those top 35 years, those Social Security taxes go into a trust fund and don't increase your benefits. So they're kind of like a lost money that's going in there. So now let's talk a little bit about Medicare and how taxes are related to that. So if we look at Medicare, the one common piece that I wanted to talk about is the IRMA cliff. So IRMA stands for Income Related Monthly Adjustment Amount. And the emphasis here is on income because it's a monthly tiered surcharge, which just turns into a tax that's taxed onto your Medicare Parts B and D premiums. It happens if you have income over $88,000 for singles and $176,000 for married couples. So if we take a quick look at what this means, here we have George and Martha. They're a high earning married couple. They're both on Medicare B and D participants. The IRMA surcharge, which they take a look at 2 years prior, this couple had $275,500 in their modified adjusted gross income. So what happens is they're going to owe a surcharge of tax on their Medicare premiums. So they'll owe tax because what they're doing is they're hitting this IRMA cliff, which basically just is a surcharge on their Medicare premiums. Which if we look here, you'll see the Part B IRMA chart. So now they're into this chart where they're in the 222 to 276,000. So instead of owing 297 each for their monthly Medicare Part B premiums, they're going to owe $386 each month. So it's extra money that they're owing for their premium. But it doesn't just stop there. Their Part D premiums are also impacted. So they're each going to owe another $19 per month on their drug plans. So it's an extra $466 combined per month that they're going to owe for 12 months. So over the course of the year, and it comes out to a significant amount that they're going to owe. So in this case, they're each going to owe $2,600, $5,200 combined for the year. So if you take that amount, when you look at this stock sale scenario, it was an expensive sale. So that's why you do want to look at, selling capital gains and capital gains tax and changes to it. It's in the news, especially over the past couple of weeks, with proposed changes that are going into it, including, some estate planning things like step up in basis. And when you sell an asset now, there are definitely tax consequences that you do have to look at. So you have to look at them from obviously here on the IRMA, on the Medicare side, but also on the capital gains that you would owe on those sales as well. The other thing that's important is just making sure you enroll in Medicare at the right time. So they actually have a pretty severe penalty. It's a lifelong penalty if you were eligible and you should have enrolled in Medicare and you don't. So definitely enrolling at the right time is an important thing to do. And it's all coordinated with open enrollment. Are you covered by an employer plan when you turn 65? And there are different rules that you have to follow. And then also whether you're covered by your own plan or whether you're covered by your spouse's plan. So it's just an example that if you do miss, there are missed enrollment penalties, which in this case, they're 10% of the base premium for the rest of your life. So it is a severe penalty that you obviously do want to avoid. All right, so we've seen Social Security, we've seen Medicare traps. They have their unique rules, their unique penalties. But you're probably wondering, are there any other tax traps that you're going to face in retirement? So the rest of what we're going to cover, isn't in Social Security. It's not the IRMA cliff. What we're going to look at now is how the tax code in plain view can snag retirees when there's no planning. So that's going to bring us to our third key, which is you must plan how and when you'll use your taxable, tax deferred, and tax-free assets to manage your income and tax brackets efficiently. And managing the tax brackets is probably the most common tax planning strategy we're doing right now for both pre-retirees and retirees. And there are ways to optimize it and save money, be more efficient with your taxes now, as well as for the rest of your life. So let's take a look at first addressing a question I hear often is, what accounts, I'm about ready to retire, I'm going to start drawing on my assets. What accounts do I tap first, or what accounts do I spend first? So here's a common example. Sam and Mary, they've been good savers. They're looking forward to spending their retirement years traveling, seeing their grandkids. In addition to Social Security benefits, they each have a $450,000 IRA. They each have a Roth IRA, and they have a joint bank account. They've estimated that they think they need to spend about $8,500 a month, just about $100,000 a year. And their question is, well, how should I draw on these assets? Where should I take money first? From what account? So most people think first take the after-tax money from the bank, then takes the tax-deferred IRA money, and then takes the tax-free Roth IRA money. And this you could deem as the conventional wisdom. It's been promoted by many big investment firms. It's not a bad plan, but we always know everyone is different, and what makes sense for one person may not make sense for everyone. So conventional wisdom isn't always the best approach. So not surprisingly, this topic has drawn attention of academic researchers who specialize in retirement distributions or financial planning. And they've conducted all these different studies on how to prepare for retirement using a combination of Social Security, taxable bank accounts, tax deferred accounts like IRAs, 401ks, pensions, and tax exempt Roth accounts. So you can see some of the study titles here, and their research concludes that the conventional wisdom isn't always ideal in how someone should do it. So here's an alternative approach. And there are two key elements in the early years. First, use the taxable bank money for expenses, but also during that same period, accelerate IRA distributions during otherwise low income years, putting that money into a Roth account. So that's basically doing Roth conversions while your income is not that high. Again, it goes back to the managing the tax bracket, managing your tax brackets or your tax buckets. This one is specifically called filling your tax bracket. It's an alternative approach which gives you more flexibility to use that tax-free money strategically in future years. So it definitely does make a big difference. In these academic studies that I referred to prior, the approach has been shown to increase portfolio longevity, and that's basically means how you don't run out of money or how you make your assets last longer in retirement. So big takeaway is that you have to plan all the way through retirement, especially how you handle those tax deferred assets. And obviously, talk to your tax professional for tax advice, but you want to look at what are the tax brackets that I'm at now? What potentially could tax brackets be in the future? The benefit of that Roth conversion is that you're hedging that tax bracket bet. So the way the Roth works is you pay tax now so that you never have to pay tax in the future when you take the money out of the Roth. So if tax brackets go up to 30, 40, 50, 60%, having money in a Roth is obviously beneficial because when you take the money out, not having to pay tax on it. So we're going to talk a little bit more in detail of those Roth conversions. So the bad news about the Roth conversion is the amount that you convert, it's added to your income for the year and it's taxed at your whatever your current tax rate is. So if you convert $100,000 of your IRA to a Roth IRA, it will show that you've added $100,000 of income in the year that you make the conversion. So for that reason, a lot of times full IRA conversions don't make sense. But if we look at the how can it be planned using a bucket strategy or a bracket strategy, it doesn't need to be all or nothing. So the way the filling up the bracket strategy works is you may find yourself in the middle of one of these tax brackets with room to add more income without pushing yourself into a higher bracket. So just as an example, in 2021, the 22% tax bracket for married couples filling a joint return was about $81,000 to $172,000. So if you file a joint return, your taxable income is $100,000. That means you can add another $72,000 without of income without going into the next tax bracket. So it might make sense to add some, do a Roth conversion, a partial Roth conversion of some of that money into a Roth, just to make sure you don't go into the next tax bracket. So, and then what you do is you evaluate it the next year and you see where are you in the bracket and is there room to add more to your conversion or to your Roth. And then, this helps in a lot of different areas. One of them is, if you remember, we talked a little bit about that Medicare IRMA surcharge. IRA distributions are one thing that can bump you up into having to deal with that penalty. You may think, okay, I'm retired, I'm gonna have some Social Security income, I don't have that much other income. But when you start taking RMDs, some of them, you can have significant RMDs that you have to take each year, dependent upon your IRA, and it can bump you up into a higher tax bracket. The benefit, the higher tax bracket, which as well as owing an IRMA surcharge or an IRMA penalty. However, if you convert your IRA to a Roth, whether it's partially or over time fully, and you take money out of that Roth, that is not included in that IRMA surcharge calculation. So the money comes out, you've already paid tax on it, you don't have to pay tax on it. The other benefit is it's not subject to that calculation to determine if you owe IRMA tax on it. So, you can look at different, you may have years where your income are low. It may be that you stopped working, but yet have started pulling money out from your IRAs, or you haven't taken Social Security yet. So when it comes time to file your taxes, you may be in a low tax bracket. Recently saw someone who was in a 12% tax bracket who was retired. And we looked at Roth conversions and they were able to convert some of their IRA into a Roth at the 12% tax rate. So it was like really a cheap conversion for them to do. For some other people, it may not be. And you just have to evaluate it, each year that it comes up and see, does it make sense to do or not do. All right, so this is a good time to spell out crux of a couple different things. So you really want to know, we're talking about filling up a tax bracket. You also want to look at, is it possible to get to the lower tax bracket? So, you want to look at it on both sides of it, not just, okay, how do I fill up the tax bracket, but also, are there any deductions or credits that I'm missing out on taking? Should I take the standard deduction? Should I itemize? And dependent upon answers to those, you may want to do the reverse. Instead of trying to fill up your bucket, you may want to try and get to a lower bucket. So, knowing your goal, knowing what you're trying to do is an important piece of it. Okay, so Kira, we'll stop again. Any questions yet?
Yeah, there's one question. Earlier you spoke about applying for Medicare and how there can be a penalty. The question is, if you are 65 and still working, do you have to apply for Medicare if you are receiving benefits from employer? Can you apply and not use it so that you do not get penalized?
Yeah, so the way it works, yeah. So the answer is yes. You can apply and you're not forced to at that time take Medicare. And start paying premiums on it. That's one of the caveats or the waivers of it is if you're in an employer-sponsored healthcare plan and you have coverage through there, you're able to, you don't have to go on to Medicare at age 65. However, if you do retire or if you change jobs and you're not covered by a plan, then that's when that clock starts where you do have to apply.
Okay, great. That's the only question so far.
Okay, so just back to the tax brackets, a couple other tactics that you could use. You may have a life insurance policy that has some cash buildup. You can withdraw from that, which may not show up as taxable income. You can sell some highly appreciated stock that you have, so that you want to look at that taxable, and are there any assets that you have that may not generate income. You may have to pay capital gains tax on it, but it may not generate may not bump you up into higher tax brackets, or cause any Social Security premiums or Medicare surcharges. And then also, if you're at that lower rate, it may make sense to take money at that point from an IRA or a 401k. So again, you just want to look at all the different options you have to manage those tax brackets. So a couple of other pre-retirement strategies to think about. And there are certain, you have to have a certain type of, in this case, we'll talk about a health savings account. Health savings accounts are great because you get basically there's a triple tax benefit to it. You get a deduction, you get to defer taxes on it, it goes to pay medical expenses, and when you take money out of it, you don't have to pay taxes. No other vehicle, Roth, pre-tax IRA, 401k, has all three of those tax benefits on it. So it's really a great tax tool. And then the other thing is, if you are a small business owner and you want to be savvy in retirement, you can fund the company pension plan, which for certain high earning business owners, it can increase their ability to claim what's called a qualified business income deduction. So, basically depending upon what situation you're in, you want to explore all options on how you can, save money. In this case, these two are pre-retirement. So, if any of these situations apply to you, again, I'm happy to have that free consultation with you to just figure out kind of, do they apply, and is there something that you can do to improve your situation? Okay, so we've seen throughout the presentation the critical importance of managing the tax deferred accounts, because once you're over 72, you don't have a choice. You're forced to take out required minimum distributions, or these are also known as the RMDs. And that can really be troublesome to your tax bill, because I've come across people in these shoes, and they're having to take out 50, 60, 70,000 a year, and they come back and they say, well, I don't want to take it out. And the IRS doesn't care. They say, well, we've allowed you to have this tax deduction and tax deferment on this account for all these years. Now it's time for the IRS says it's time for us to collect our tax on it. And they'll say, well, how can I do it and not pay tax on it? Can I put it here, or can I move it here? And the answer is really no. The IRS is going to collect their share of your pre-tax 401k or IRA. One thing you can do or look at is a qualified charitable distribution. So that's if you're inclined to charitable giving, you're over 70 and a half years old. So one thing you can do is up to, if you're older 70 and a half, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. So if you're married, both of you are over 70 and a half, both of you have an IRA, you can max out that $100,000 each from your own IRA. So the way it works is any qualified charitable distribution you make counts towards satisfying that required minimum distribution. However, when you make that distribution from your IRA, it must go directly from the IRA to the qualified charity. And the way you can do this, you can receive a check from your IRA custodian made payable to the charity. So there are a couple of ways to do it, but you just have to make sure you follow the rules. And because it's coming from an IRA, even though it is charity, you're not getting that tax deduction on it. So why would I suggest the strategy where you get no deduction for giving to charity? Because when you make this qualified charitable distribution, the distribution is never counted as taxable income when you compute your taxes. So again, you're not getting you've already gotten a deduction on this IRA money. You're not getting a second deduction on it, but you're not having to pay tax on it. And it counts as it can count towards your RMD. So here's a quick example of what happens when you have a non-qualified charitable contribution. So here we just have two people, Albert and Shirley. they take their required minimum distribution of $5,000 beginning of the year, deposit it into the bank. So he's done with his RMD. Now he's charitable. He decides to donate $5,000 to charity. So end result, charity gets $5,000. Makes sense. But if you look at it, by doing it in the steps that he did it, his charitable contribution is going to cost him a total of $6,200. And that's because the $5,000 RMD that went into his checking account at the beginning of the year has a tax implication to it. So they're in a 24% tax bracket. 24% times 5,000 equals 1,200. He owes 1,200 in additional taxes when it comes time to pay his taxes. So that's the $5,000 plus the 1,200. Now, if he did it using a QCD or qualified charitable distribution, the way it works is instead of requesting the $5,000 distribution from his IRA to his bank account, he has the IRA transfer the $5,000 directly from IRA to charity. So that satisfies his RMD because he's over 72. The charity is in the same position as it was before. It got $5,000 donation. It's happy. Albert and Shirley, they're in a better position. They still gave $5,000 to charity, but even though they're not getting a deduction, their IRA distribution is excluded on their tax return. So they owe no income tax on the $5,000, and their total cost is $5,000, exactly what they contributed to the charity, which is a $1,200 savings over the previous example. And this is simply by knowing how to donate correctly to charity. So again, knowing the rules is important. So how does tax planning question I get is, how does retirement tax planning figure on home, on how assets that I want to keep in the legacy planning, right, that I want to keep in my family? And it's a really good question because the government still wants its share of those tax deferred assets when you pass away. Remember, the IRS always wants to get its share. Uncle Sam is coming after those IRAs. So how you set things up, it really matters. So that brings us to our final key, which is number 4. So you want to organize your assets for your family's benefit. Estate planning still matters. You know, people have over time, they've looked at the estate tax credit or estate tax deduction, which is the amount of an estate that you can pass on before you start getting hit with estate taxes. And it's all over the place. At one point it was 0, meaning all estates are taxed, up until it was at one point 6,500, then it was doubled to 11,000. And at various levels, people said, well, I'm never going to have an estate that much. I don't need to worry about it. Well, estate planning is back in the talks now. And the deduction is in the talks now, and it may change, it may be lowered. So how you organize everything is critical in terms of how much of your estate will be left to pass on. So, you know, it's also not really a fun topic to talk about. It's always relevant, but not many people come in and say, yeah, I want to talk about my death. So we're not going to talk about it in the traditional way here. The new tax law, it excludes estates valued up to $11.7 million from federal estate tax, which, small caveat on that, if you're in a state like that I'm in New Jersey, that estate tax exclusion is a lot less. So, you know, you may not hit the $11.7 million estate, but your assets may cross over whatever state you're in, that state's exclusion, and you may still owe estate tax on it. So the very important tax issue remains around how your assets are received by your beneficiaries after you die. One example is making sure married couples plan for what right now is still available is a step up in basis, which it's a tax rule that readjusts the value of an inherited asset. So its value is not what your spouse or descendant paid for it initially. Instead, it's stepped up to the price on the date of death, which can really make a big difference, which we'll see. And it's most likely that most of the assets you own, other than your retirement accounts and any annuities that you have, they'll be eligible for a step up in basis. So here we'll look at Phil and Mary. They're married, they own a variety of taxable investments in a joint account, which is titled as a joint tenants with rights of survivorship. And there's different ways to title joint accounts. The investments in there, they have a long-term capital gains of $120,000. So one day bad news comes. Phil's diagnosed with terminal cancer. He has 18 months to live. Let's see how this works with two scenarios. In the first, Phil and Mary make no planning changes to their assets. When Phil dies, Mary receives a step up in basis on Phil's half of the joint account, which is $60,000. She'll still receive, she still faces that future $60,000 of unrealized gains on her half of the account. So that means if Mary decides to sell all the assets, she'll owe tax on her $60,000 of gains. But suppose that upon Phil's diagnosis, Mary and Phil move all of the investments into one account in Phil's name. Then, as long as Phil lived longer than 1 year, Mary would receive a full step up in basis on the entire $120,000 account. So simply put, Mary could sell that account and pay no tax. Simple question here is, when you sell your investments, would you rather owe tax on $60,000 a gain or zero? Obviously planning around death is hard, but this is one area where a professional can help because they're emotionally removed from the situation and can assist you in making good decisions that may seem hard at that time to make. Okay, so maybe you're someone who's managed to save up quite a bit in your IRAs or your 401k. You feel confident that you'll be comfortable in retirement. You're hopeful that you'll leave your accounts to your children. And in the past, we've recommended that because with the right structure, your heirs could withdraw money throughout the lifetime, even their decades, based off of their life expectancy. But that changed with the passage of the Secure Act in December of 2019. So now beneficiaries of inherited accounts, with some exceptions, must withdraw all the money within 10 years of their owner's death and pay tax on that money. So again, Uncle Sam says, we used to let you withdraw money over a longer period of time. Now we're going to accelerate it because we need money. We need to collect taxes on it. So here we're going to look quickly at Pamela and Kyle, example of what choices beneficiaries have when they inherit IRAs and no longer can stretch those distributions over a lifetime. So the first scenario involves Pam and her son, Kyle. Pam unfortunately passes away, leaves her full IRA to her son, Kyle. He's an only child, the sole beneficiary of the IRA. So we know now that Kyle has a maximum of 10 years to withdraw the IRA to meet those required minimum distribution rules. Kyle likes the regular distributions, so he chooses to take equal distributions over the next 10 years. The IRA earns an average of 6% return on, annually on the IRA. So this payment would calculate to $54,347 to Kyle each year for 10 years. He'd have to add this amount as income on his tax return for 10 years for each year. The second scenario for Kyle looks a little bit different. He lost track of time. He's already reached the year 10 of his required minimum distribution window. Since it's year 10, he must now take out the full distribution in 1 year, which again, assuming that same 6% rate of return, which is earned annually on the $400,000 IRA, you can calculate the IRA balance has grown to $716,000 and $716,339. So he must take the full $716,339 as a distribution in year 10 and pay income tax on that amount. That is definitely going to put him in the top tax bracket for that year. So again, it's tax brackets, it's planning, it's how do you withdraw money, which is critical to to basically being as efficient or as optimal as you can. So a couple other things I wanted to finish up with. One is taxes and long-term care. So again, obviously, this is not a long-term care presentation. It's about retirement and taxes, but there are some tax breaks associated with long-term care insurance. So for one, long-term care premiums may be a deductible medical expense at the federal level and possible for eligible deductions or credits at the state level. On the other side, if you're receiving long-term care benefits, in many cases, those benefits are tax-free. So if, for instance, benefits received from a reimbursement style policy, they're definitely tax-free. In addition, cash benefit style policies are tax-free if they don't exceed the higher of your actual long-term care cost or an IRS daily limit, which is currently $400. So, choosing how you pay long-term care costs, it can have a big impact on your estates and heirs as well. So in recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. so these are something that you may want to look at as well on these hybrid qualified plans as well. Or you can take out a separate policy for long-term care, or you can choose to self-insure. And that's one of the things we help people do, that analysis and look and see, yes, this, taking this one of the three options is what makes sense. Okay, so again, it comes down to a comparison. It comes down to scenario planning, which is one of the big things that we do. And planning for long-term care, one of the things on how we plan for it is, as we're putting together a retirement income distribution plan, we build in these different scenarios. What happens if there's a long-term care event tomorrow? What happens if there's a long-term care event in 10 years? And we can model that and show, how does it impact the assets? Do the assets now run out? Or is there still enough assets and you will be able to self-insure against a long-term care event? Or maybe it makes sense to purchase long-term care insurance, and we'll look at what the cost is versus what the benefit is and see if that makes sense to add to someone's structure or someone's plan as well. Okay, so we're coming towards the end, and you're probably wondering, I just blitzkrieg through a bunch of tax topics, and you're wondering, how in the world will we ever manage this? So what I'm going to try and do now is bring it all together. So we started with a clear statement about the problem, that retirees often pay more taxes than expected because we have a confusing system. It treats various income types differently and contains hidden taxes and hidden penalties. So quick review of what we've learned in the context of the 4 stages. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, which is something that makes sense or optimally to do in your early retirement years or in low tax years. We also looked at Social Security and taxes, plus the importance that couples have with their benefit strategy that considers a surviving spouse. We saw how Medicare has its own tax-like structure that can push you off the IRMA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because if starting in the middle retirement years, you'll be confronted with required distributions. And we've seen the importance of planning your income needs before then and the tax issues that come along with that. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most of that goes to your heirs and leave them with the most tax flexibility as possible. So all those items together lead us to the obvious solution to the original problem, which, because your tax exposure will change throughout retirement, you obviously need a strategy. You want to anticipate how and when you can tap assets to cover your expenses. You want to understand how the range of taxes you'll face at various stages, and you want to obviously have a strategy that manages your actions so that you pay the lowest tax rate possible. So, by attending this presentation, you're obviously have some concern over transitioning from that accumulation to distribution phase, or moving from one of those 4 stages if you are already retired. We've seen that the distribution phase, it's more complicated than working and collecting a paycheck and automating some savings to your retirement or your account. Naturally, we all want to be as efficient as possible with our savings. And there are strategies that you can do to reduce your tax burden. But like everything, it just takes education, and it takes planning, and it takes time and advice. So it's a lot to think about. Our tax code's complex. The rules are always changing. And the only thing that doesn't change is that you need a plan to do this. So I'd like to help you get started. As I mentioned in the beginning of this presentation, I offer a tax and retirement planning overview meeting. We'll look at your individual situation, see if you're missing out on some strategic things that you could do. And you want to look at it, the tax planning through four lenses. Like the first one is, I don't do any tax planning. The second one is, I do tax planning for this year. The third one is, I do tax planning for the rest of my life. And then the fourth one is, I do tax planning that impacts generations and my heirs and my beneficiaries. And you can look and determine where you are in those 4 levels. But I think most of us would want to do as much tax planning or as much tax optimization as possible. So if you go to my website, bautisfinancial.com, there's the ability to schedule that free consultation. I'll also be sending out the replay to everyone with a link in that email on how you can, again, schedule that free consultation. We'll take a dive into what you're currently doing and if there are any changes that are easy to optimize or implement. Okay, so Kira, I'll turn back to you one more time. Anything else pop up?
Thanks, Mark. No, there's no additional questions.
Okay, so again, thanks everyone for attending, and I'll send out that replay along with the ability to set up that tax meeting. So thank you.